Good evening, everyone, and welcome. My name is Chuck Denninger. I'm a member of Lord of Life. I'm also a member of the Endowment Fund Committee. The Lord of Life Endowment Fund, it exists to support and expand the ministry of Lord of Life now and into the future. Our congregation has grown and is able to do great things in Jesus' name. There's always more to do, and we know in the future the same holds true. The fund will enable Lord of Life to do more and to be able to reach out with this gospel in new and innovative ways. Please note that the monies donated to the fund, for all intents and purposes, stay with the fund. It's the earnings and appreciation that are used to further Lord of Life's ministry. Bobby Hermanson Albers is an estate planning attorney with BGS, Barna Guzzi Stefan. We hope that you are going to be able to gain some insights and ideas for your own estate planning. And again, I want to thank Bobby.
Well, thank you so much, everybody, for taking time out of this gorgeous March evening. Tonight, we'll be addressing some various mechanisms that each of us can give to organizations like the Lord of Life Endowment Fund. And there are lots of different ways we can do it. And so we'll just walk through and focus on what are the different ways that you can actually give to the endowment fund. Like they said, I work closely with Bill Hefner. He is one of our senior shareholders here at Barna Guzzi and Stefan. He's been doing this a heck of a lot longer than I have, but he and I work closely together on our estate plans for our clients. And we have had multiple opportunities to meet several of you at Lord of Life, and we're grateful for those opportunities. And we appreciate the opportunity to provide our communities with some information about estate planning. So thank you to the Endowment Committee for having us back again. I've been with BGS for about 2 years, and like I said, I really enjoy working here at BGS. I plan to be here for a long time. And I feel like with 30 attorneys, approximately, we're able to meet a lot of our clients' needs. So we have several attorneys in several areas of law, and there are very few clients that come in the door that we can't help. There are primarily two ways that we can give, just kind of overarching ways we can give. We can plan gifts, and by planning gifts, I mean gifts upon our death, and make an estate plan or some sort of asset be payable upon our death to the endowment fund. Second is a lifetime gift. You can make gifts during your life, before your death, and there are various avenues you can do that with. Some of these types of gifting options are more estate planning geared. Some of them are things that I would probably tell you, you really should speak with your accountant or your financial planner about that option to get more of the detail that you might want. But I'll give you kind of a brief overview. I'm going to steal a phrase from Bill Hefner, the senior shareholder, that he uses all the time, and it's funny because it's so appropriate here. I know enough about certain things with financial planning. I know enough to be dangerous. That's what he always says. And so if it's one of those things, I'm going to let you know that that's definitely something you'd want to run past your financial planner and get more information on. Planned giving to Lord of Life. And planned giving, again, is going to be providing for Lord of Life upon our death and making Lord of Life, their endowment fund, part of your estate planning. And how you can do that is you can make them a beneficiary in your will or in your living trust. Those options we kind of reviewed in detail in the last presentation. But if you have any questions about that, you can certainly watch that presentation, follow up with me with any specific questions you have. I'm more than happy to answer them. The next thing is you can make them the beneficiary of a life insurance policy. You can make them a beneficiary of a retirement account, and you can make them a beneficiary of a financial account, maybe an investment account, a banking account, payable on death or transfer on death, making them a beneficiary of that account. And when you list somebody as beneficiary on these types of assets, you're avoiding probate for those assets. So if you have a retirement account, you don't have a beneficiary in place, it'll subject your estate to probate. If you have a financial account and there are no beneficiaries or joint owners on the account, it's going to subject your estate to probate. So naming beneficiaries is always a good idea. And if you have a certain amount in mind, if you have an asset that's, a retirement account that's worth $50,000 and you were thinking of leaving $50,000 to the endowment fund, that's a perfect asset to name the endowment fund as a beneficiary on. All of these assets above can be a percentage or a dollar amount. It doesn't have to be, you don't have to say it's all going to Lord of Life Endowment Fund. You can be a percentage or a dollar amount. And one thing I will say is whether you do a percentage or a dollar amount is going to be really dependent on what type of asset it is and exactly how much you have in your estate, what types of assets you have in your estate. There are times where I say you definitely don't want to leave a specific dollar amount, and times when I say you definitely don't want to do a percentage. It just depends, and I won't go into too much detail about that. So estate planning is what Bill and I do the most of here at BGS, among some other things. But if you attended our last Zoom presentation, you heard the detailed discussion about the various estate planning tools that we use for our clients. And there are several tools that we use, but we covered the most common tools. And while I'm admittedly biased, I really do think estate planning is important for every person. And I think it's important that you decide where your life's treasure goes upon your death. And you decide who it goes to, but also you decide when it goes to that person. Some of the most, I should say, not terrible, but some of the most challenging probates that we have dealt with involve beneficiaries who are taking under the statutes where there's no will and they're 18 years old and they're getting a very large sum of money because maybe one of their parents had a premature death. In that instance, an 18-year-old doesn't necessarily make the best decisions financially. And with some estate planning, you can help them manage the money over a period of time. But for today's purposes, we're going to focus again on how you can specifically benefit the endowment fund with your estate planning. The only way you're going to be able to make a gift after your death to Lord of Life is through estate planning. If you don't do any planning, Lord of Life doesn't have an automatic claim against your estate. So they would, if they came in and they said, she told me 10, 20 times that she was going to leave $20,000 to the estate, it would be next to impossible to actually recover that unless there was some estate planning in place prior to death. So if it's your intent to leave some sum or percentage or any gift to the endowment fund, it's a really good idea to get that estate planning in place. And if you do decide that estate planning is something that you need in order to make that happen, or you'd just like to get your estate planning done, please give Bill or I a call and we'll be more than happy to kind of walk through your options with you. And again, I've included our contact information in this slide, and you can reach out directly to either of us at any time. I will also say I regularly meet with clients who have put it off their estate planning because they're worried that it's going to be extremely painful, difficult, complicated. It's going to take a ton of time. But it really isn't that complicated once we get started. Most of the time, depending, I guess, there are those stray estate plans that are very complicated. But a basic estate plan typically takes anywhere from 3 to 4 weeks for us to get through. So from beginning to end, from our initial meeting until you're signing the documents, and we're recording whatever we need to record in terms of real estate. So it really isn't that difficult. There's some legwork up front, just getting documents ready, getting some information to us in terms of who you want to name as your fiduciaries, but it's not that complicated. The other thing we would do is we would give you a very good idea up front, at the initial meeting. What are you looking at in terms of time? How long is it going to take? And what do we'll give you a firm quote. What will it cost? And you're not obligated to do anything. You can take your time and consider it and decide, when you're ready to proceed. You're not going to be charged until you tell us, yeah, I really do want to do this. So retirement accounts, leaving the endowment fund as a beneficiary on a retirement account is a really great way to give and to maximize your assets. And here's why. If the income from your retirement fund is going to be taxable income upon withdrawal, Lord of Life is a tax-exempt organization. They're filed as what we call a 501c3, tax-exempt organization. And they're not going to incur the taxes that an individual beneficiary would incur upon withdrawing those funds from a pre-tax fund. And to be clear, when we're talking about, taxable retirement accounts, we're talking about 401ks or IRAs that are often funded with pre-tax dollars. So like my 401k, I contribute to that before taxes through my employer. And that's typically, how these are funded. Naming Lord of Life as beneficiary on that asset will maximize that asset by avoiding that income tax on the withdrawals at the time of your death. There are some specific cautions that I wanted to put out there for you. If you do decide to make Lord of Life's endowment fund a beneficiary of your taxable retirement account, you're going to want to contact your plan administrator for your retirement account and go through a few steps. First of all, you're going to want to make sure they don't have any restrictions on naming a 501c3 entity or charitable entity as a beneficiary. This is not a common thing to have restrictions where you can't name a charitable entity as the beneficiary, but some plans do have them. So it's really important before you just do it that you make sure there are no restrictions. As a former divorce attorney, I can tell you, you also need to have spousal consent. Even if it's your retirement account, it's considered a marital asset if you're married. So you're going to need your spouse to sign the right papers, and make sure you work with the plan and identify exactly what papers does my spouse need to sign in order to make a beneficiary designation. You also want to get a written confirmation from the plan confirming they've actually received your beneficiary designation. There are so many times where people are sure that they've completed these beneficiary designations, and then you contact the plan and they have no record of it. So it's important to make absolutely sure that, when you name Lord of Life Endowment Fund as the beneficiary, that you have some sort of receipt or document that shows that the plan has changed the beneficiary designation, and that's the current designation. And then it's a really good idea to make sure that Lord of Life has a copy of that beneficiary designation. I'll talk a little more about that at the end, but when somebody's like a charitable entity is a beneficiary and an asset, I typically will advise that you let them know that. So at the time of death, they can do what they need to do to recover those assets. If a charity is one of multiple if a charity is one of multiple beneficiaries on your retirement account, you would want to speak with your plan advisor also and your financial advisor to discuss any pitfalls that can possibly result from having a combination of charitable entities and individuals, for example. Usually there aren't any, but you want to be absolutely sure that there aren't before you do that, especially if you are past the age of 70 and a half and you can make charitable distributions. And if you want to use that charitable distribution, you will want to make sure you talk with your plan about whether it's a good idea to have both individuals and charitable entities. So during your lifetime, there are multiple ways that you can give. And some of those ways include giving cash, making your tithes and your offerings every year. And that's how we traditionally have given, many of us have traditionally given to our church during our lifetime, putting money in the offering plate. You can give, up to $15,000 to an individual per year without incurring a gift tax, where you have to file a gift tax return. $15,000 is the gift exemption. So per couple, that's $30,000. Gifts of appreciated stock those are a wonderful way to give to a charitable entity. And here's why. It actually might benefit you to give stock that you've had that's appreciated over a long period of time, to name or gift it to a charitable entity, because you will avoid the capital gains tax. So just to kind of walk through that, let's say that you had stock 20 years ago that you purchased for $100,000. Now it's worth $300,000. If you were to sell it now, that difference of $200,000 is going to be taxable as a capital gains tax, and it's taxed at a rate of 20%. So you can do the math, but that's a significant amount of tax. Whereas if you give it to the charitable entity, the endowment fund, they're not going to realize that tax because they're a 501c3, and you won't have to worry about that charitable distribution. It makes more sense than giving the endowment fund cash. So if you had investment accounts that you were going to cash in and then give the cash to the endowment fund, you'd actually be losing money doing that. It would be way more efficient to just gift the investments to the endowment fund and avoid that capital gains tax that you would pay if you cashed it in. Gifting real estate, you can actually gift real estate to the endowment fund. And what you can do, even if it's your home, is you could say, okay, I'm going to leave my home to the endowment fund, but I'm going to retain what we call a life estate. And a life estate is a right to use and enjoy and live in the property during the remainder of your life. Upon your death, the remainder beneficiary or the endowment fund would take ownership of the property and do what they want with it, whether that be sell it and retain the funds in the endowment fund, or maybe use the property for something else. You can actually gift real estate. It doesn't have to be your home either. It can be land or cabin or any type of real estate and business building. You should definitely meet with your financial advisor to determine whether there are any additional ways that you can give to a charitable organization. And one of those ways is a charitable gift annuity. I'm not involved in writing annuities or anything like that, but I know that there are financial advisors that do that. I think some life insurance agents do them. And, it might be a really good way to do it. And basically what that is you're setting up an annuity where you're giving a large gift to the endowment fund, and they would pay you the income over your lifetime. And then at the time of your death, they would be the remainder beneficiary, and what's left would belong to the endowment fund. But that's something that I don't draft here, but that would be something you could work with a financial advisor or an agent of some sort, a life insurance agent. The last gifting during our lifetime that we're going to address is a charitable remainder trust. And this is something that Bill and I do for our clients, where they can give money during their lifetime to an endowment fund. And a charitable remainder trust, what that basically is you're creating a trust, and you're entitled to take the income during the lifetime and any principal if you'd like, but a trustee is going to manage it for you. And so, let's say that you have $100,000 in it and you're getting $10,000 in income each year. That would be a really good investment. But if you were getting $10,000 in income, you would get that $10,000 every year. But then upon your death, the endowment fund would have whatever was left over. at that time. And this is an irrevocable transfer. This type of trust is considered an irrevocable transfer. So if you are concerned at all about Medicaid planning, this would actually be a good option for you, because once you have given an asset to an irrevocable trust, then that asset is no longer owned by you. You have no ownership rights whatsoever. And then a 5-year clock starts. And after that 5-year clock has run, it's not subject to any clawback by Medicaid or medical assistance upon your death. So if you work with an elder law attorney and you do some sort of Medicaid planning to make sure that if you needed nursing home care in the future or something like that, long-term care, and you didn't have any other way to pay for it, that your assets aren't going to be taken and liquidated by the county. So this type of trust is a really good idea if maybe it's an asset you don't necessarily need and you want to protect it, but you also want to give to the endowment fund. That would be a great option for you. And then because it's an irrevocable gift, you receive an immediate tax credit. So you get a charitable deduction on your tax return.
At this time, I'd like to introduce Cheryl and Greg Meyer and have them explain why they've designated Lord of Life Endowment Fund in their estate planning.
Hi, thanks everybody. Greg and I have been on a 40+ year faith journey at Lord of Life. And not only have we grown through that journey, but we've watched Lord of Life grow, both in brick and mortar and also as it's expanded its outreach locally and nationally and internationally, and now in the age of COVID, in the digital world. It's been an enormous privilege and faith growth experience for us to be involved with Lord of Life for this amount of time. We're so grateful for the pastors and the staff that have been through, every phase of our life, the joys and the sorrows that we've gone through. We've been an amazing small group Bible study group for year 17 this year. So we've gained lifelong friendships through that. We've taken advantage of adult education, the chance to pray together with other members, the social activities like owls, and of course, the great music and the sermons and the youth and family programs when that was appropriate for our family. So really our faith has grown exponentially during these times and through these experiences. And we really feel like it's given us so many opportunities to truly live out what we say every week at the end of our sermon, loved by God and sent to serve the world.
We decided we wanted to contribute to keeping this legacy at Lord of Life going well into the future. And that's why we support the endowment fund. Both now in life, we've made contributions, and then we have it as a part of our estate plan. We feel that the endowment fund is a nice vehicle to ensure that we keep the legacy going, and it's our way to say thank you for all that the church has done.
I'm ready when you are, if anyone has questions.
All right, I'll ask a question. When you're choosing I don't know, they used to be executors, but now is it personal representative, or you seem to use another word? I can't remember, but whatever it is, like it seems like people usually choose a kid. I don't know. What works the best, do you think?
I think it depends on the situation. There are some situations where one of your children is a great option. It's important, though, that the other children get along with that sibling, and that, that one, you can trust that person to do the right thing. There are times where it makes more sense to have a third party, like a fiduciary, serve in that capacity. Maybe you have a trust that you want to be managed for several years. And it's possible that your children may not have maybe the patience or the expertise that you need in order to administer the trust how you want it administered over that period of time. When you're talking about the estate, it's a really big job. I will say that being a personal representative of an estate is a big job. People are always surprised what a big job it is once they start. And it's about 6 months to a year on a really easy probate. So it's a significant investment of their time and energy. If you don't want to do that to one of your children, there are lots of wonderful fiduciary entities, or some people use trust companies as fiduciaries, and they're always available, and that's always a good option. We typically use a company called First Fiduciary here in the Metro, and they literally have a staff full of people that are very accustomed to doing these things. This is what they do all day, and they have a very good system. And if my clients are interested in having someone other than a family member serve in that capacity, I often recommend them.
So with a typical estate plan, how much, you said it takes 3 to 4 weeks for processing from beginning to end. What is the typical cost?
Sure, I'll give you kind of a ballpark of the various types of things that we do. So the most basic, where it's just I want a will, I want a healthcare directive, and a power of attorney. That would probably run anywhere from $600 to $700, and that wouldn't protect any assets necessarily from probate, but it would appoint somebody as your personal representative. It would have the purpose of keeping your estate in informal probate versus formal, which in layman terms means you don't have to go to a court appearance. It would just be handled administratively on paper. So that would be kind of the most basic. And then if you did like a will and a transfer on death deed, you'd be looking at, and this is just for one person, you'd be looking at probably $800 or $900. This depends a little bit, but somewhere around that. And if you did a revocable trust or something, it can run anywhere from $2,000 to $4,000. It really depends on what assets you have and how much transferring we need to do and record into the trust. And when I'm giving you these numbers, this doesn't include expenses and recording fees and filing fees for the court. That would just be just attorney time.
Bobby, I have a question related to retirement funds and taxable retirement funds and the age of 70 and a half.
Yes.
And some of the changes that have been in place because of the pandemic. So could you kind of clarify what is happening now on that? And,
sure.
and how it can benefit people, whether it's Lord of Life or a college that they want to contribute to, or a tax exempt organization, what that means.
So at age, I'm going to go through a little bit of the background of the law to help it make sense a little more. So with the implementation of the Secure Act, which was passed in December of 2019, the required minimum distribution age was raised from age 70 and a half to age 72. And this is the age at which you are required to start taking your minimum distribution from your retirement account. We also have what's called a Qualified Charitable Distribution. Often you'll see it as a QCD, where you can give to a charitable organization without incurring tax. And that is at age 70 and a half. So what you can do there's a window of time that age 70, it's 18 months, age 70 and a half through age 72, is you can reduce your taxable gross income by giving to a charitable entity, taking those minimum distributions that you're required to take at age 70, start taking them at age 70 and a half and instead of waiting until age 72, and give those minimum distributions to the endowment fund. And basically what you're doing is you're reducing your gross taxable income. And that can also have, I know that that's used to calculate your Medicare payments, and Medicare Part B. And the other thing, I'm sorry, I'm referencing because I actually wrote notes about this because I figured this question may come up. And it also has the result of possibly reducing the minimum distribution amount that you're required to take at age 72 because you elected to take it a little bit earlier than you were required to do it. So that is a good way to reduce the taxable income, basically for yourself.
I got a couple questions.
Sure.
So one, how does Lord of Life use their endowment fund? And what if you have some, special interest at church that you want your funds to go to? Can you direct them in the endowment fund?
The monies that are deposited with an investment firm that we use in Faith, those dollars stay there year after year. They're not used directly. But based on what the Church Congregational Council has authorized, they would pull off 4% each year that would go to things that are consistent with the church's ministry philosophy and policy. And right now what we're doing is using it for some grants that are applied for. So the fund itself is not that big right now, but the funds that are donated, those will last pretty much in perpetuity.
Another question she had, though, that is fairly important. She asked if there was something that they would like to designate those funds to be used for endowment. Again, they can be used for a specific designation, as I understand it. But again, we would take the earnings off of that to use it for that specific purpose. So, for example, if $50,000 was donated for a scholarship fund, what they would do is use the investment money that they have gained over the years to pay out that scholarship fund. So that is a possibility. The majority of what we are seeing going into our endowment fund are not designated. So there are special projects where people or organizations can apply every year to ask to use some of that money. And again, it's specific to our ministry.
I could add one thing to that, actually. I do know that there are some tax rules around making any sort of direction with charitable gifts. So if you give too many instructions about how the money can be used, that can affect whether or not that is considered a tax exempt gift. So
correct. And we pretty much had two lawyers look at the church's policy.
Yeah.
On how to use these funds, and they wouldn't be directed, number one.
Mm-hmm.
And then number two, those funds would not go out in the year that they're received. It's the earnings that would go out pretty much.
And that's exactly correct. So the endowment fund has everything in place.
Oh, I know what the other point was. When these grants do come in and the endowment fund committee reviews these grant applications, if they meet the certain criteria and the committee feels, let's go ahead and recommend this to the congregational council, then the congregational council has to approve that and say, yes, thumbs up, we'll do that. So it has a lot of eyes looking at it. It's not, oh, I have this one preference over here. Let's use this fund for these funds for this purpose. So there's a lot of eyes on it. It's very seriously managed and monitored.
Yeah, so every year we are given the amount that we can kick off from the money that's been earned, and we have real specific things we've talked about. I mean, the general statement is support and expand the ministry of Lord of Life now and into the future. And it really would be for things that, you know, those folks in 2040, they're going to have to pay their own way for pastors' salaries and paying the heat. This would kind of be some special things, and we've talked a lot about how you support a lot of endowment funds, and I think this would be us too, might support members of our church who decide to go to seminary. So you're creating leaders into the future.
I do have a question. In the context of a trust, could you explain what the function is of a spillover will and how it works?
We usually call it a pour over will. Is basically what that means is you're going to say, upon my death, I'm going to have all of these expenses that I've itemized in my will, like your funeral expenses, any tax expenses for your estate, last illness expenses, and then any expenses of getting personal property to people, maybe shipping costs. Anything that's left over after all of those things have been done is going to go into the residue of your estate. And what a pour over will does is it says whatever there is in that residue of my estate is going to pour over into my trust and be administered as though it was in the trust the whole time. And that way your trust, exactly how you've worded that, is going to control how things get distributed upon your death. And so you're not having to maintain two separate documents that are identical, which can be problematic if you're making updates, as the years go forward. So a pour over will basically just says, okay, my personal representative is going to take all of those assets, give ownership of them to my trustee. My trustee is going to distribute them as though they were in the trust the whole time.
Bobby, thanks again for using your free time tonight to make this presentation. And again, it's for some of these topics, myself included, it's almost like drinking out of a fire hydrant. But you help make that manageable.
Thanks, Chuck, for leading us, and Bobby, we just really appreciate you and your great spirit, and especially your knowledge on this. So thanks so much.